Hi, and welcome to Janken's Guide on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, I'm going to explain why dynamics are so important to risk management and risk modeling. And that this is an area where many companies' financial and risk models fall short, which means that there is ample room for improvements by building risk models with a higher degree of analytical integrity. So for a more extensive discussion about analytical integrity, please consult my book, Empowered Enterprise Risk Management, co-authored with Petter Kapstad. There's also more information on my webpage, riskbudgeting.se. As they say here on YouTube, please like and subscribe. All right, so the initial observation here is that dynamics in risk modeling is of supreme importance. Because if you think about it, risk management is a lot about being informed about what happens in different scenarios. You know, things are moving, there are contingencies and you know, things play out differently outside expectations. And it's important that our model, you know, when something changes in that model, the rest of the model needs to adapt dynamically to that for the model to have credibility, to be able to depict reality in a realistic way, right? So, but many real-world models are not designed in such a way that they have this kind of analytical integrity, and the dynamics are rather poor. Too many things are insensitive to the main sort of developments in the model or a scenario. You know, crucial links are missing that connect different parts of the model, right? So when that happens, it becomes an unreliable guide to decision making. If you implement some kind of a stress test and only a select few lines are impacted by that, well, that's going to be an inaccurate description of the corporate group or the consolidated corporate performance in that scenario. So it becomes an unreliable guide, and we want something that has more analytical integrity and something that you can have more faith in across a wide range of different scenarios. Everything needs to hang together in the model. So the context in which this modeling takes place is risk budgeting, which is an approach to risk management where you express and view risk through the lens of the firm's financial performance. So you build dynamic forecasts of cash flow, net income, balance sheet, and financial ratios. And you derive risk measures from that setting. You find a way to express risk and keep track of it using such a model. And this allows us to move beyond the limitations of the risk register, a very common output in enterprise risk management programs that collects a lot of information about risk, but it lacks the structure to allow us to aggregate that kind of risk up to the level of the company as a whole. So even with all this information, we lack ways to express overall risk. You know, what's the risk return profile of the company as a whole? With risk budgeting, we're able to do that. And crucially, we're able to apply different scenarios and different corporate policies to see how risk changes and be, you know, informed about that beforehand, and so that we can have a proactive sort of approach to risk management. So that's the setting in which we're having this discussion, right? So risk management has to be supported by a quantitative risk model. It's inevitable, you know. The complexity is such that we can't, you know, do this back of the envelope. And you need a couple of things to be able to, you know, design such a model successfully so as to function as a decision support tool. And you have to have accounting integrity and a complete set of integrated financial statement forecasts. That's the basis. We discussed that in other videos. Today, you know, it's going to be analytical integrity. There are some other components to such a model. You know, it has a number of features that we need to try to meet and take care of before it becomes a reliable guide to decision making. But for today, it's analytical integrity on the agenda. The other items are discussed in other videos. So what is analytical integrity then, if we continue that discussion? Well, it's when the model's cost structure, broadly defined, how that responds to changes in revenue and risk factors. And we want that cost structure to adapt dynamically and meaningfully to changes in assumptions about revenue and or risk factors. So every company has a cost structure in place, costs on various levels. And when outside risk factors change, or when revenue change, let's say it drops 20 or 30%, what's going to happen to the cost structure? The answer to that question has a great deal to do with analytical integrity, because we want that to be realistic and follow, to the best of our abilities, a realistic path for the firm in that scenario. So we can compare analytical integrity with accounting integrity, which we have already looked at in previous videos. So let's say you define gross profit as revenue less cost of goods sold. Well, there's accounting integrity for you. It's actually how it's defined. We're supposed to write gross profit in a model in that way. So that's accounting integrity. It's perfectly consistent with our definition of gross profit. Analytical integrity, on the other hand, is when cost of goods sold changes or responds correctly to changes in the assumption about revenue. So we want the response to be realistic and correct. All right. So whenever we change our assumption about revenue, let's say what's going to be our new assumption about cost of goods sold. That's where analytical integrity is so important. And when we say cost structure, again, we mean that in a very broad sense, and all the firm's overall costs of many sorts. What comes to mind usually would be cost of goods sold, right? And then selling, general, and administrative expenses. These are pretty much core costs in most firms, right? And they're operating in the sense that they're part of the firm's business activities. But costs also include capital expenditure, which you maybe don't always think about in those terms, but it is actually a cost of doing business. You have to invest to stay competitive, and unless you do, you're being outcompeted, right? So to stay in the game and stay relevant, you have to invest, and that's a cost of doing business. So we're going to view that as a cost here as well, and it's actually called capital expenditure, right? Hinting that it is indeed a cost, and depreciation in the net income statement is a proxy for that. It's supposed to capture the cost of investing. So it's appropriate to think of capital expenditure as a cost in this bigger picture view. We also have financial expenses that are related to various liabilities in the firm's balance sheet. Also going to be supremely important to understand the firm's risk profile, right? What kind of financial expenses are there connected to these liabilities? So all of those three elements are going to presumably change in one way or other when we modify the assumptions related to revenue or risk factors, right? And how we do that matters greatly then. So first, if we take cost of goods sold here as an example for the time being, let's say that we first assume that it's the same in all scenarios, regardless about what we assume for revenue. We're going to compare that with another assumption, which is that cost of goods sold is a constant percentage of revenue, meaning that it just follows. There's a ratio that connects cost of goods sold to revenue, and that ratio is constant, so it just follows. And here we can see, compare the two cases. Here we have the scenarios: down 30%, meaning revenues down 30%. Here's the expected scenario, our best forecast. And there's a good scenario when things turn out for the better. All right, so here, reflecting our assumption that, cost of goods sold is constant regardless, it's flat at 1.2 million here. All right. Using this assumption instead of a constant ratio, that the cost of goods sold is a constant fraction of revenue. Well, then it dynamically adjusts so that in the bad scenario, when revenue is down, cost of goods sold are also down. So which assumption are you going to use? Because the risk is quite different. Look, I mean, this is the gross profit in the bad scenario here with the dynamic assumption in place. So you come out okay, probably there's some positive numbers here that you possibly could, get you through this bad scenario. Here, you're down to a much lower number. Maybe this is considering all the other costs you have and liabilities to service, etc. Maybe this is a problematically low number. So this very assumption is going to be a huge determinant of the risk profile. Right? And many times you find that companies are too, unrealistic here. They leave it flat across a number of scenarios, which could then, impact the risk profile in a way that was never intended or correct. You're not following through on what you know about the business. So the assumption is of great importance here to our conclusions about the risk profile. So there's something to be said for thinking it through and not just being lazy or complacent about these assumptions. So we are going to introduce a bit more dynamic features here into the model. Also, same thing with the selling general and administrative expenses. We have a similar situation there. If you leave it flat across scenarios, well, you're going to exaggerate risk. And unresponsive costs, generally, the implicit assumption is that you have operating leverage, you have fixed costs, you can't get out of them. And that always implies more risk. Higher operating leverage is the same thing as saying high risk. So that is often, not explicitly said or assumed, but it's implicitly assumed. Whenever you leave your cost flat across scenarios, well, that's operating leverage, and that is a determinant of risk. So, well, then, what if we think about it for a bit and we realize that, look, we have these, we can actually exit these costs. If the bad scenario comes to pass, we're not going to sit around and just accept all these costs. We're going to exit from them. We're going to cut some of the costs. Well, if we realize that, well, we might as well instruct a model to reflect that. Similarly, we might find upon thinking, that if the good scenario comes to pass, we are probably going to have to commit a few more resources to support that. I mean, that's expansion in a way, and expansion usually requires more resources. So that's another way we can get more realistic assumptions here, right? So again, look at the change in risk here. We're now at the operating profit level after subtracting these SG&As. Here you have the flat assumption in place. So this is maximum operating leverage. So obviously the risk is going to be higher, right? Here you recognize that, okay, we can exit some costs in this scenario, whereas we're most likely going to have to support this expansion with by committing some more resources, all right? Dynamic assumptions versus static assumptions. So most likely this is more realistic, and it is possible to using some simple instructions to have the model reflect that. So we can greatly exaggerate the actual risk by forgetting about these dynamics, right? And on a deeper level, if you reflect on it even further, you realize that this is a lot about managerial flexibility. You can do things conditional on certain scenarios. So that's flexibility. You're not stuck in a certain mode of operating always. So, and flexibility is a generic risk management strategy. The more you have it, the less risk you have. You can modify your position. You can get out of certain unattractive positions, and that's risk reducing. So the question becomes, how can we use that prior knowledge, where we can surmise or assume flexibility, let's incorporate that into our assumptions. All right, that plays out very much in the context of investments, right? Investment is something you can defer. You can choose to wait. You can choose not to do it, you know, and so there you definitely have some flexibility. And what you might want to do is scale back capex when you realize that the world isn't developing as you first thought it would, like you had hoped and planned for, you know. Then when it turns out the reality is different and not as good, well, then maybe we don't want to invest as much anymore. It doesn't make sense anymore because, you know, they're not as economically defensible anymore. So this is a kind of a natural hedge. You know, the stronger this correlation, the lower the risk. I mean, oil companies, when the oil price is down, it's less attractive to invest. They're not going to want to invest as much as they did when prices were high, right? So that's a risk dampening circumstance, right? So when the supply of funds is low, like cash flow goes lower, the same thing happens for demand for funds. Capital expenditure is going to be less. You know, the desired level of investment is going to be less. So why don't we try to find ways to describe that in the model as well? Just a few more, you know, instructions in the model, and that can be accurately reflected. So again, the net cash flow here after capital expenditure is much more solid in the case of a dynamic assumption, where reflecting the fact that in the bad scenario, where our desired investments are less, right? Whereas we're expanding over here, supporting more investments in good scenarios. All right. So similar logic is applying here. So the less risk, the more of this kind of flexibility you have, the less risk you have, and the corporate risk return profile in your model should capture that. So because these things can be anticipated, right? We don't have to pretend like we're not able to think this through and come up with improved assumptions. So we want the model to have state contingent capex assumptions as well, so that there's some response to this cost element when revenue changes or the risk factor changes. Perfectly possible. And then you have on the other, you know, we were talking about managerial flexibility. That's a favorable form of flexibility, right? It works to your advantage. You can get out of some costs, but there's also the opposite, which is flexibility that works against you, which is when somebody else has flexibility to exercise an option, and that's typically written into contracts, right? Contingencies that exist in contracts. So, and they're usually triggered by some threshold level being reached. They write the contract with reference to some price or rate in the market or whatever, and whenever somebody else has a clause like that in a commercial contract with you, let's say, well, and you can assume that they're going to use it when it's favorable, and that then is a new kind of liability for you, introducing possibly more or higher costs. So the cash flows will deviate negatively from expectations in these cases. So contingencies work against you then if the flexibility, because flexibility is with somebody else. So a lot of times they also appear in financial liabilities, derivative contracts, convertible bonds, guarantees, margin calls. All these things imply that the counterparty has flexibility and they will use it against you when it's favorable to them. So that can be anticipated and doesn't have to come as a surprise. And the extent to which we can write that into the model, you know, the more important ones of them at least, then fewer people in the organization have to be surprised. You know, you can be dynamically modeled and surprises will be fewer. So we essentially about designing the model to keep track of all these contingencies, the major ones. Look at pension cash contributions, for example, for those who operate a defined benefit plan, right, which is unfunded. We have some plan assets that potentially could fall, you know, the value of those fall below the value of liabilities if the stock market develops negatively, let's say, and you may be required as a firm then to inject more liquidity into the fund to maintain a positive ratio of the plan assets to plan liabilities. So maybe it's fair to assume that this would coincide with a low revenue state, that the same factors that are driving the revenue lower is causing the plan assets to fall in value. Well, if that's a reasonable assumption, well, why don't we have the model reflect that, so that in the bad scenario, when revenue is down and profits are down, you might also find a spike in cash commitments here on the line pension cash contribution. So this is reflecting one of these contractual contingencies, right, which you have knowledge about. So again, the risk picture is more realistic because in that scenario, you will have another set of cash commitments to service. So again, you have the analytical integrity of the model now to make it a better guide to decision making. All right, so risk management models, the dynamics is of central importance here. Everything has to hang together. The more they do so, the better they describe risk and they can support your decision making. Basically, analytical integrity is about how the fund's cost structure responds to changes in revenue and risk factors. That you have well thought out assumptions in place for that, making them state continuum. So, and we can anticipate places where we have flexibility working to our advantage and contingencies working against us. A few of the bigger ones, we can grab and try to describe and incorporate state continuous assumptions in the model, and you will have a greatly improved decision support model for risk management. All right, please read more in my books, Corporate Foreign Exchange Risk Management and Empowered Risk Management. Check out my website, riskparting.se, and please like and subscribe. Thank you so much.